Hello, everyone, and welcome to Fundamental Auditing, Chapter 5. Chapter 5 is talking about preliminary audit planning and understanding the auditee's business. So when going through the audit process, the first thing you have to do is pre-engagement activities. So this means that before you even accept the audit client, you have to figure out if the audit client is right for you, like if you should be accepting or rejecting the audit client. So that's what a pre-engagement activity is. And then once you have accepted the audit client, you can do some preliminary audit planning. So that includes risk identification, so determining what the risks are for the audit client. So looking at their business risks and determining what the audit risk is. So the audit risk that I've mentioned in previous chapters was the risk that the auditor is not going to find, or the risk that the auditor is going to give in wrong opinion on the financial statement. So they're going to say that it is a clean opinion, or it's unmodified when it's actually modified, or the other way around. Okay, so what auditors are going to do is do a risk identification, find out all the risks, and then they're going to do procedures or plan procedures to address those risks. They're also going to do some internal control documentation and possibly internal control testing. So internal controls are kind of the day-to-day operations. What controls do they have around their day-to-day operations so there isn't misstatements in the financial statements? So the auditor needs to gain an understanding of all the internal controls and possibly test the internal controls as well. Then auditors need to make a decision on sampling, how much of each account they're going to test. So for example, for revenue, how many revenue items they're going to test. They're not going to test all of them. So when I say test, that means getting the evidence. So how many things are they going to get evidence for to make the conclusion that the revenue is free of any material misstatements, or the inventory is free of any material misstatements. So they're not auditing 100%. They're going to look at some sampling. So in internal controls, we're going to look at more in chapter 7 and chapter 9. Sampling decisions, we're going to look at in chapter 10. And then we're going to do substantive procedures. So then we're going to dive into looking at what type of procedures do we do to gain the evidence necessary in order for us as auditors to make our opinion. Okay, so substantive procedures, we'll see a little bit of that in chapter 8, and then from chapter 11 to 14. Then at the end of the audit, after you do your substantive procedures, you're going to review all your audit findings. So take a look at anything that you found that was material, figure out what the total errors are, go back to management and say, okay, are you going to fix these errors? Get them to fix it or have the discussion. And then you're going to form an opinion and issue a report. So what report you issue was part of chapter 4. Either an unmodified opinion you would issue or a modified opinion. You might have some emphasis on matter paragraphs, so like an extra paragraph as well. Okay, so that's basically the whole audit process. Okay, so first figure out if you're going to accept or reject the audit client by doing pre-engagement activities, then figure out all the risks, figure out what procedures you're going to do while you're planning the audit, internal controls, testing, sampling, substantive procedures, and then review and form an opinion. All right, so when we're looking at pre-engagement activities, that means we need to decide whether to accept an audit client and whether to resign from an existing client. So every year, so if you have the same audit client, every year you have to do these pre-engagement activities to determine whether you're going to continue on with this client or you're going to resign from the existing client. Okay? And then for a new audit, a new client that has come in and says, I want an audit done, we need to do some procedures to determine whether or not we're going to accept the audit client. So risk management, so the auditors are going to try to reduce the risk by carefully managing the engagement. So when they're looking at their pre-engagement activities, whether or not to accept their client, they need to look at how risky this is. What is the probability of something going wrong? Can we manage that risk? Or if we cannot, maybe we shouldn't accept the audit client. They're also they're going to manage the audit in accordance with the quality control standards. They always have to keep that in mind, whether this could be adhered to. So some of the pre-engagement procedures that you would do before you decide to accept an audit client, you can obtain and review the financial statements of that audit client. So you can ask for the financial statements and review them. You can review them if there's any really complex transactions that you're not familiar with, then maybe you don't have the competence to do the audit. Or if you don't have the competence to do the audit, maybe you want to hire an expert to help you or something. So that's all you need to take into account. So you want to obtain and review the financial statements to see, is there anything unusual there, anything that pops out on you that you were like, oh, maybe this is too risky to take on the audit client. You're also going to do an evaluation of independence. So we talked about independence in chapter 3. So you're going to see if you or your staff, so all the people that are on this audit project, if any of them have an independence issue. So is there a self-review threat, self-interest, advocacy, familiarity, or intimidation threat? So is there any threats to independence that would lead you to not accept this audit client? You're also going to look at the competency and the resources. So you're going to look at the competency of the auditors. So are the auditors competent in order to carry out the audit? So for example, if your audit firm only did audits for companies that were following ASPE, and now there is a company that wants you to do their audit, but they follow IFRS, are you competent enough to do that? Yes, and that's something that you have to look at and say, okay, do we have the competency to audit and the experience to audit an IFRS company? And they have to look at resources too. So they look at what type of deadlines are there. If the client is pushing for a really quick deadline, you can't rush the audit. So maybe you won't be able to get the audit done by their deadline and you would have to reject it. You look at all the staff that you have. Do you have enough resources to carry out this audit in order to take the time to get the sufficient audit evidence you need? You're also going to understand the business and understand the business risks. Maybe you can go and do a Google search, look for any news reports. Is this company in public scrutiny for something, or getting sued, or are they going bankrupt, or what's going on here, and what is it that you want to accept? You can consult with legal counsel to determine if this is too risky of an audit to take on or not. You want to consider whether this engagement requires special attention or involves unusual risks. Okay, so is there some sort of complex transactions that we are not as auditors competent with? Do we need to hire an expert to help us do that? So you want to check if there's any risks or any special attention. You're also going to communicate with the previous auditor. So if this client has been audited in the past by some other auditor, you would talk to the other auditor and ask them if there is anything that they should know before they accept the audit client. Okay? So there has to be some communication between the predecessor and successor auditors. So there are rules. So the rules of the professional conduct require the successor auditor to contact the predecessor auditor. So you have to do this. So you have to ask if there's any issues that should be considered in accepting the client. And you can obtain information from the predecessor auditor for planning the audit. You can actually request to get the predecessor's auditors working paper files, so all their documentation, their full documentation file of the audit, you can ask to have that. And the reason why you would ask to have that is to determine if they did the audit appropriately and got the sufficient amount of evidence for you to be able to rely on the opening balances. So remember what I said in one of the other videos, you're not just auditing like the 2020 current year numbers, you're also auditing the 2019 numbers because your financial statements will show comparative numbers. So if the 2019 numbers were audited by somebody else, you want to obtain their working paper files to determine if that audit was done sufficiently and enough evidence was obtained for you to be able to rely on those numbers. The predecessor auditor is required by the rules in the CAS standards in order to respond to this communication. So they can't, like if they're mad that they got fired as an auditor and now a new auditor has taken over, they can't not give them any of this information. They have to do it because it's part of the rules. Okay, so the new auditor has to talk to the old auditor and ask if there are anything that they should be aware of before they accept the audit client. And the predecessor auditor is required by the rules to provide the truth. So once you have done all your homework and figured out that yes, this is an audit that I am willing to accept, then there's a bunch of things that you have to do. So you would have to sign an engagement letter with the client. So the engagement letter kind of lays out, it's kind of like the contract that you would sign. So it lays out what the auditor's responsibilities are and what the management's responsibilities are. It lays out, what type of fee arrangement is, what type of things the auditor has, like the fact that the auditor needs to have access to like all the files and maybe have to go and visit all the different locations. So it just it's basically a contract between the auditor and the auditee. Then I think there is an engagement letter example in this chapter, so you should go and look at that. Then the auditor is going to assign a team to do the audit, and depending on how big the audit is, there is going to be an engagement partner that oversees the audit. Then there's going to be maybe an audit manager, and then some senior audit staff, and then like some staff assistants or junior level staff. There could be a specialist or an expert if required. There could be like a tax or consulting partner. So if the auditor is looking at, for example, like the tax expense, like the current tax expense, deferred tax expense that is on the financial statements, they might get a tax partner or somebody in tax to look at that in more detail if they're not really experienced in accounting for taxes. Or get a consulting partner to help them out for anything that's complex, and then a second partner review might be needed. Second partner review is needed for public companies. They have to get an auditor if there's one engagement partner doing the audit, there has to be a second partner reviewing that audit. Okay, so depending on how big the audit is, it depends on how much staff you need. But you do need to have a partner that's overseeing everything and signing off on the financial statements at the end, or signing off on the audit report. And then it could be a mix of like some management, some senior people, some junior people. Obviously, you can't have all junior people on the audit. You do need to have people in a supervisory role. Then you need to plan the timing for the work. So timing for the work could be based on like previous experience. So if you've had this audit done before, or if you've done this audit before, then you can say, okay, it took this long before and not much has changed with the company, so it's probably going to take a similar amount of time. But like if it's a new audit, like look at the knowledge of the business, look at the financial statements, see kind of how complex they are, and kind of record a time budget. And you're going to do interim work and year-end work. So interim work is before the year-end. You might go in and do some work, so you're not doing so much work at year-end, because there are like deadlines and stuff that the users of the financial statements want the information soon after year end. So the audit might start before the year end, just so they can kind of get a whole bunch of stuff out of the way so they're not scrambling after year end. Time reports for all staff are recorded. So all staff would be, at the end of the day, like they're doing their work, at the end of the day, they would have to show how much time they spent on the audit, just so they could keep track of the timing. And that's probably how they're figuring out how much fee to charge the audit client. So once an audit is accepted and you figure out your time budget and who the staff is and everything like that, you also have to do, the first kind of step in your audit is doing an audit planning memo. So you have to do a bunch of audit planning before you actually go out and do the audit. So it's usually called an audit planning memo. And this is something that you guys will have to do for your assignment. So your assignment question is going to be an audit planning memo. So you're going to have a risk assessment. So that's one of the first things that you do. You're going to look at what is the risk that there's going to be a material misstatement in the financial statements. So you're taking a look at all the business and environmental risks of the company, the economy. You're looking at what is the possibility that there are material misstatements in the financial statements. Okay, so you're looking at, okay, is this a first-time audit? If it's a first-time audit, that's going to increase the risk that there's material misstatements in the financial statements, because these statements have never been looked at by an independent party before. If there's lots of competition and management is like really pressured to show good results, then there might be a risk that there's motivation for the management to increase like the revenue numbers. So that would increase the risk of material misstatements. So like what are the biases or motivations or incentives in order to not fairly represent the financial statements? And so that's what we have to look at in the risk. So how can there be a risk that there could be a material misstatement in the financial statements? You also look at like the internal controls of the company. So maybe there's no bank reconciliations being done. So that would increase the risk that there is a material misstatement, or maybe the year-end inventory count is not being done. So that would definitely increase the risk that the inventory number is materially misstated at the end. Okay, so we do this risk assessment to determine what the risk areas are in the audit and what the audit team will focus on while they're doing their audit. Like, which areas require more focus, more samples than others. So that's one thing that we have to put in our audit planning memo. In order to figure out what the risks of material misstatement are, we need to understand the business and the business risks. Okay, so before we can determine the risks of material misstatement, which we will talk about more in chapter 6, but we need to understand the client's business, operating environment, to figure out whether the financial statements might contain material misstatements, and to just kind of figure out the overall strategy to design the audit plan. We need to look at the economic condition, their policies, their geographical location. So, do they have offices all over Canada, which means that you probably have to go to a bunch of these locations while you're doing your audit. What are like the taxation rules, the regulation rules that they have to follow? Is there any specific industry characteristics that we need to know that would affect the risk that there will be material misstatements in the financial statements? So we just need to understand a whole bunch of stuff before we can do our risk assessment. So other things we have to know is, what are the business environmental risks? Okay, industry, regulatory. What are the business operational risks? So what are their strategic and related business processes? What investments do they have? Who's investing in them? What's their financing? What's their performance measures? Okay, so for example, is there if they're a public company and there's a bunch of shareholders, are these shareholders pressuring them to perform really well? Financing, who are they borrowing money from, and are these creditors, like, do they have like a debt covenant? that they've put in place. So, for example, if they say, okay, you can only you can borrow money from us, but if your debt to equity ratio is too high, then you have to give back all our money. So this could be an incentive for management to keep the debt to equity ratio low, or to misstate the amounts, so it shows that the debt to equity ratio is low, but it actually isn't. So there could be they might be hiding something. So this would increase the risk that there is material misstatements in the financial statements. You want to look at performance measures as well. So what if management's bonuses are based on net income, and management's the one that's creating the financial statements? They have pressure, like they have an incentive to increase net income and maybe show wrong results in order to increase their bonuses. So we need to figure out what type of incentives there are, because that's going to increase the risk that there are material misstatements in the financial statements. Okay? So basically, the auditor needs to determine what could go wrong in preparing the financial statements. Where could there be errors in the financial statements? So they want to look at the corporate governance. So who is managing this this company? What's the management quality? Who are the related parties? Are the related parties transactions being done correctly? If there's many related parties, there's a bigger risk that those transactions are not recorded properly. We have to look at their internal control. Do they have really good controls, so that they can detect misstatements or prevent misstatements? What are their accounting policies? What is their information systems like? So do they have really good information systems that automatically calculates the sales number and automatically takes that amount out of the inventory account and puts it in the revenue? Is everything kind of connected and it can output the financial statements? Or are things done more like more on Excel, for example, and they don't have an information system that they use? Yeah. So you want to look at all of that to determine what is the risk that there could be material misstatements in the financial statements. Here, another thing that you do at the beginning and also end of the audit is analytical procedures. So analytical procedures are things that you would have to do as part of your audit planning and as part of your audit. So there's kind of 5 types of general analytical procedures. So examples are, you would compare your current year account balances with previous year account balances. So if revenue was 2 million this year and 1 million last year, well, how come it went up so high, right? So like, these are things that you're doing so you can start questioning. If your revenue didn't go up at all, but the clients kept telling you that they have all these brand new customers, well, why didn't revenue go up if you have all these brand new customers this year? Okay, so compare current year balances to previous years, compare current year balances with those of the industry. Okay, so look at the account balances of the company you're auditing versus their competition. And if something's like really out there, then that's something that you would have to question and get more audit evidence for. Compare current year account balances with company's anticipated results. So look at budget versus actual, and why was there such a variance there? Evaluate relationships of current year balances to other current year balances for conformity of predictable patterns. Study the relationship of current year balances to relevant non-financial information. So like I was saying, if the client's telling you one thing, management's telling you one thing, compare that to what the numbers look like to see if that makes sense. Doing horizontal and vertical analysis. So you have learned this in your accounting courses, but basically horizontal is looking year over year. Vertical is looking at taking all the amounts in the income statement and comparing it to sales. So, salaries and wages expense are like 20% of sales, but office expenses are 5% of sales. So if that has changed a lot from current year to previous year, then that's something that you need to question. So analytical procedures are something that's done for auditors to determine what they're going to question. So if something went, something changed from previous years to current year, you want to go and ask those questions of why they've changed. So yeah, like I was saying, like analytical procedures are most effective when they're integrated with other sources of information. So you do your analytical procedures, you find a variance, and then you go and ask the questions of why there's a variance, and whatever answer you're getting from management, then you go and corroborate that information by finding the evidence. Okay, other like early gathering information activities that could be part of analytical procedures is reviewing the accounting misstatements that happened in prior years. So if they had errors in prior years, you want to make sure those errors didn't show up again. Having conversations with audit personnel. So you're talking to, you want to try to talk to a bunch of employees at like different levels of the company to see if there is anything going on that management might not be telling you. You want to read like the corporate charter, the bylaws, review the contracts, agreements, legal proceedings, study the minutes of the meeting, right? So if in the minutes of the meeting of like board of director meetings, for example, so you want to read all of the board of director meetings. If the board of directors said we're going to pay out a dividend in September, but you don't see any dividend payments out of the financial statements, then that's something that you want to look into more detail and figure out, well, if the meeting minute said that there was going to be a payout of dividends, why is this not reflected in the financial statements? Similar thing when you're reviewing contracts or agreements. If you see like a lease agreement, for example, but you don't see any lease expense or any like leased asset on the financial statements, then you need to question that. Or if you see loan agreements, but you don't see that reflected in your liability section, then you would have to question that. Okay, so analytical procedures are basically for you to figure out what are the risk areas and what am I going to go and get more information for. Another part of the audit planning, so audit planning memo, is materiality. So we talked about how when auditors are providing an opinion, they're providing an opinion that the financial statements are free of any material misstatements. So I explained what materiality was at the time. If a number is material, then it affects the decisions of the users of the financial statements. So if there was a $20,000 error in the financial statements, that might not affect the decisions of the users. But if there's a $150,000 error in the financial statements, that would affect the decisions of the financial statement users. Okay, so we need to figure out in the planning stage what the materiality number is going to be. So materiality is the largest amount of uncorrected misstatements, the largest amount of misstatements that we will find in the financial statement, but we can still make the opinion that the financial statements are fairly presented. And if there's errors above that materiality number, then we couldn't make a cleaner, unmodified opinion unless the client corrected those mistakes. So in order to figure out the materiality number, we need to know who the users are of the financial statements and why these financial statements are important to the users. So we need to, like, in your audit planning section under materiality, you're going to say, okay, these are all the users one by one. This user is interested in this, and that's why they're looking at the financial statements. So like a bank, for example, would be interested in the bank would be interested in the net income number because they want to make sure that the company is making enough net income every year in order to pay the interest payments and then eventually pay the principal repayment at the end of the year. Or if the bank has a covenant in place and says, your debt to equity ratio can't be higher than a certain amount, they're interested in the debt and the equity amounts in the financial statements. an investor might be focused, so an investor could be another user of the financial statements. They might be focused on the net income number as well, because they want to make sure that the net income is high enough for them to, like, get paid out their dividends, or for them to keep investing. Maybe they want to decide to pull out of the company, and if they're not making enough net income. So you want to make sure, like, you want to understand what are the users looking at in the financial statements, and look at that number, and that number forms your materiality amount. Another example that I talked about, if management bonus is based on net income, or let's say if management bonus is based on the revenue, then maybe materiality should be set on a percentage of revenue. Or if a creditor is loaning money to the company, but taking collateral, so taking a security collateral of all the capital assets of the company, then maybe materiality should be based on a percentage of their total assets. So it really depends on who the users are, for you to figure out, okay, what number in the financial statements are these users most concerned about, and then we'll take that number and figure out a percentage of that number we're going to use as materiality. Let me just, before I go into that slide, let me just show you the guidelines. Okay, so like I was saying, you need to figure out what number is most important for the financial statement users, and then we're going to figure out our materiality amount based on that number. Yeah, so these are just some kind of quantitative guidelines. So we could do 5% of net income, for example. Usually, yeah, we can do anywhere from like 3 to 10% of net income is usually the industry guideline here. Like, there's no right percentage, but it's usually when you're using net income, anywhere from 3 to 10% of net income would be your materiality amount. You can use revenues or expenses. So non-for-profit entities, the users of non-for-profit organizations would probably be concerned about the expenses, because they want to make sure expenses are not too high. So you might make materiality based on expenses, and that's usually 0.5 to 2% of revenue or expenses, 0.5 to 2% of total assets, 0.5 to 1% of net assets, or 1% of revenue for the real estate industry. So you first have to look at the users of the financial statements, who they are, and why are they interested in these financial statements? What number or numbers are they most concerned about? So net income, revenue, and assets are the most popular, but expenses, shareholders' equity could also be there as what you use for materiality. So you're going to figure out, okay, what number is most important for all the users? So if it's net income, for example, then you're going to figure out, okay, what percentage of net income am I going to use? So you can use anywhere from, like I said, 3 to 10% of net income. To determine what percentage out of that you are going to use, you're going to, so instead of 5%, 5% is like average, but it can be anywhere from 3 to 10%. Revenue can be anywhere from 0.5 to 2%. Same with assets. So this could be for revenue or assets. Okay, so if you are deciding between 3% and 10%, the more important this number is to financial statement users, the lower the number should be, okay, with the average being about 5%. So if there's many users of the financial statements, and like if there's a bunch of creditors, if there's investors, if management bonus is tied to net income as well, and everyone's kind of looking at net income, and there's a lot of users and they're really relying on this information, then you probably want to go closer to 3% or 4%. If there's, just one owner manager, it's a small company, there's nobody else looking at the financial statements except for maybe the bank, then maybe you can do a higher percentage. Okay, so the more important this number is for the users of the financial statements, the lower the percentage should be. Okay, so from any of these, the lower the percentage should be. If the number, the more important the number is to these users, the more users there are that are relying on this number, the lower your percentage should be. Okay. So that's how you choose what the materiality amount is going to be. There's also something called performance materiality. Okay, so you have to plan materiality as a whole, which we just talked about. There's also something called performance materiality. Performance materiality is basically like a buffer. It's a buffer that will leave room for any error and reduce the possibility that the total misstatement exceeds materiality. Okay, so if we decided, okay, there we go. If we decided that net income is going to be our materiality amount, or it was what we're going to use for our materiality, and net income is 100,000, and we decided we're going to use 5% as our materiality number, our materiality is going to be 5,000. So this is our materiality. For performance materiality is basically a buffer and that we use, and that buffer is going to have like a cushion. It's a cushion for misstatements that might be undiscovered by the auditors. So instead of testing and looking at anything over 5,000, maybe we'll say we're going to look at anything over, so our performance materiality might be like 4,000. So we're going to say, you know what, we're going to look at everything over 4,000 just in case we miss like some errors, or just in case a total of a couple errors would be over our materiality number. So this is basically a buffer that we'll use as a cushion. So like just in case there's a whole bunch of errors that are 4,999, right? So we're going to miss it if we're only testing and looking at things that are higher than our materiality number, higher than 5,000. So we kind of set up this little buffer in order to catch anything as like a cushion for us. So performance materiality is usually somewhere between 60 and 90% of whole materiality. Okay, so you take whole materiality. So here I think this is 80% of the materiality. Okay, this is going to be based on the risk of material misstatement. So we talked about how we're looking at the risk of material misstatement. The higher the risk, the lower the percentage of performance materiality. Okay. So higher the risk that there is material misstatements in the financial statement, the lower the percentage of performance materiality you're going to have. Okay, so the lower this PM is going to be. If there's lots of risks that the financial statements are materially misstated, then maybe you want to make this number 3,000 instead. So you're looking at everything over 3,000. Oops. Sorry. So you're looking at everything over 3,000 instead of looking for anything over 5,000, just to give you a buffer. My controls are going all haywire. Okay, so yeah, so performance materiality gives you a kind of a cushion. You're going to audit everything over 3,000 instead of 5,000, just in case there's something that is missed, or if you find a lot of errors, like 4,900, then maybe you want to bring down materiality, or you want to investigate those further. Okay, so you can revise materiality, like you figure out materiality at the planning stages, but you can always revise it after if you're finding like so many errors and so many mistakes that are just under materiality. You might want to decrease materiality just so you can get the client's attention and the client can fix the mistakes. All right, there's some qualitative guidelines you look at when you're figuring out materiality. So materiality is based on the users of the financial statements. If it's a new audit client, what's going to be are the clients interested in the share price, and what numbers are going to, in the financial statements, are going to affect that. So you're looking at the users of the financial statements. What are they most concerned about? and you're taking that amount and applying a percentage to it, the more important that number is to the financial statement users, the lower the percentage is. All right, so that is the end of chapter 5. Thank you for listening and take care.